Right, so welcome and good morning. And we want to tackle a part 2 of what we call changes in group structure. Now, remember, we started with changes in group structure in the part 1 video. All right, and we said that what we are doing, we have a change that is an acquisition. So we have a broad sub-heading, which is an acquisition. And we learned that under acquisition, there can be media acquisition, which is very basic. And we saw an example of that in the first part of the video. But there is another one that is called step acquisition, and that is what we will be looking at here in this video. Then not only that, there is another aspect that is called what we have disposal. All right. So in the disposal too, we have partial disposal and we have what full disposal, where they dispose everything and when they dispose something small. All right. So we'll be looking at that disposal. So here we'll be looking at disposing full disposal, disposing everything, then disposing to leave a residual interest, which is a subsidiary. All right. So we call it partial disposal. So you are not disposing everything. You are doing part. So we have partial disposal. And you'll be leaving some of it. Let's say you're leaving what? Residual interest. And where that residual interest, what you've left is still makes you have a subsidiary. Then we have a partial disposal where what you left, you are leaving a residual interest, but that residual interest that you are leaving will still give you an associate. And we have another one that will still give you IFRS 9, an investment. So that is that. We call this one, we will tackle this particular one under what we call control to control. All right, so we will do that. Control to control. All right, so basically that this is what we have. So we are looking at, and we have already tackled media acquisition. So now let's pay attention to step acquisition. All right, so let's deal with step acquisition. Now, what is step acquisition? What do we call step acquisition? And you remember in the complex group structure that I gave a hint about that. All right, so we look at step acquisition. So we are looking at an acquisition where control is gained over a subsidiary in stages. All right, so basically that is what it is. So inside step acquisition, what you have is that the control over a subsidiary is in stages. So let's say first they buy 10%, another time they buy 30%, that means they have 40, and another time they buy like 15%, making 55. So at the point of 55, clearly you see that there is control, all right, and that is a step acquisition. But please be careful and take this important note from IFRS 3. IFRS 3 said that acquisition accounting, so acquisition accounting is only applied when there is control. So it's only applied. And please take note of that. That is your basic principle. It's only applied at the date. At the date control is achieved. Control is achieved. Remember that if control is not achieved, it's either you have an investment or you have an associate. And if it is an investment, you do IFRS 9. If it is an associate, you will do IAS 28, equity accounting. So please take note of that. All right. So that is that. So I'm going to give you 4 scenarios you can have when it comes to these things. All right. Because what we see here is that first, let me say A, that you have a pre-existing equity interest in an entity. And that pre-existing interest in an entity can be accounted for in 3 ways. So all your pre-existing interest, because you don't have control yet, all your pre-existing equity interest in an entity can be accounted for in these various 3 ways. By saying that we will apply IFRS 9 in the case where you have a simple investment. And I just said that. So this one, in terms of percentages, it means that you have what? Below 20%. That is that. Then you apply IAS 28 when you have what? Associates. And what? Joint venture. Now, if you have this one, IFRS, now you find out whether it's amortized cost, fair value to P&L, or fair value to OCI. All right, so take note of that. Then, in the joint venture, don't forget, that is where you do an associate, that is where you do what? Equity accounting. All right, so you can visit the video on associates, all right, to do equity accounting. Then lastly, you may have an IFRS 11 situation whereby you have joint arrangement, all right, joint arrangement other than what? Joint venture. So these are the scenarios you may face. So that is the first point I need to bring to your attention. Now, if you had all these interests and you are making a step acquisition, that, let me call it a B scenario. So at the date where you increase this pre-existing equity interest, so at the date that equity interest, that pre-existing equity interest is increased, and where the increase will bring about control, because you can increase from 20 to 30, you don't, it brings you to associate. But I'm looking at a situation where you have increased it and control is achieved. Immediately control is achieved. These are what you do. 1, and please, these are the principles. So when we start solving the question, just bring in these principles. 1, you will remeasure the previously held interest, which is part of these ones. So remeasure it. Remeasure your previously held interest. And you are going to remeasure it at fair value. All right. So that is that. IFRS 13. Step 2. What you will do is that you will recognize the gain or loss on that remeasurement. So you recognize the resulting gain or loss. All right. And that will go into your SPL. So that is that. So let's say previously, somewhere I had, let's say 20%. Previously, I had 20%. And that 20% was like, let's say 100,000. Then I buy an extra 10%, or let me say 40%, because control is now what? Achieved. What I will do is that this particular one, the date I had the control, which is making 60%, the day I have the control, I'll remeasure this 20%. Let's say if I remeasure, it is now 120. If I remeasure this one, it is 120, and therefore there is a gain of what? 20, which will be recognized inside what? The P&L. All right. If it is a loss, to the same thing. All right. Step 3. So what do? We will calculate goodwill. All right. We will calculate goodwill and NCI using what we have. So you do your NCI. If your NCI is on what do you call it, at fair value, use fair value. If your NCI is at proportionate, you do that also. So you calculate your goodwill and NCI immediately. How do we do the goodwill? How then do we do the goodwill? Now, the goodwill, we know we will need purchase consideration, right? So now, how will our purchase consideration be? So like we did here, we said that you will do fair value of the previously held interest. Fair value of the previously held interest. So we will do that. So that is, in this one, it will be the 20% we have done. All right, so we will do that. Then we will bring the fair value of the additional consideration, all right, which is the 40%. All right, so fair value of consideration for the additional interest. So we will do that. So in this case, it will be our 40%. So then we have the value for what? The 60%. So basically, that is how we do our purchase consideration. So this is how we have derived our purchase consideration. What then do we do? As normal, as you know, we will bring what? The fair value of NCI at acquisition. Is that not it? NCI at acquisition. It can be proportionate. It can be what? It can be fair value. So we will add that. Then we will less what we normally do, less fair value of net assets of the sub at what? Acquisition. So basically, that is that. Nothing has changed. The only thing that has come in is that the previously held interest, we have revalued it, and immediately we revalue. Don't forget the second step. You do the gain or loss, all right? And this is how you get your goodwill. If there is any goodwill impairment, then you also consider that, all right? So that is basically, that is that. So what you have here is your goodwill at acquisition. That is the only change that has happened. So the change will affect what we have. All right. Now, the thing is that there is another thing I need to show you, and that is this. Let's say this previously held interest, all right, had been measured already. So if there is, so that is my point C, but my point C is going to focus on this one, the previously held interest. This one. And I'm going to make this statement. So now we are saying that my point C is just to say that if there has been a remeasurement. So let me shift it here so that you can have it work. If there has been a remeasurement of, so let me write well, a remeasurement. If there have been a remeasurement of the previously held interest, that previously held interest, the equity interest in the OCI. So probably, you see, like I said, it can be fair value through OCI. If they have done that, then any changes in value, any changes in value recognized, any changes in value recognized, let me say in earlier years, are now what? Reclassified to retain earnings. To retain earnings. And I think you should understand why. By this time, following the lecture videos, you understand why. Why? Because let's say they did fair value through OCI. All right. Which means that any fair values that have been done previously is seated inside where? OCI. Because what happened is that this one is not realized yet. It's not realized yet. But immediately they now do a step acquisition, that money has been transformed as a purchase price. And therefore, all those figures that are seated in the OCI now have become what? Realized. And if it has become realized, it should go to the SPL. Now, the problem is that this one is for previous years. So we can't put it in the P&L, and we need to put it inside what? The retained earnings. So that is why, because P&L and retained earnings has the correlation. So if it is for previous years, you put it inside your retained earnings. Current year own normally is seated in where? The P&L. All right. And that is where we did the gain or loss, and we have put in the P&L. So that is that. All right. So these are, I mean, if you follow suit the lectures, you should understand how these things are treated when they immediately become realized. All right. So that is that. So that is my point C. Then my last point D, all right, will be what I call, so let me write point D, is that after you have gained control, all right, so if you have gained control and you further purchase any other shares, that one is regarded as a transaction between equity holders. And so therefore, that is the one I refer to as what? Control to control. All right. So if you had, let's say, so let's note it down. Maybe you'll be taking notes. We are saying that any more purchase, so purchasing further shares in subsidiary after control has already been attained. After control has already been attained. For example, let's say I had my 60%, all right, the one we did. Then after I had 60%, I now buy a further 15. So I go to like 75%. Please, this one is regarded as what we call transaction between equity holders. All right. So that is that. It's recognized as transaction between equity holders. And the technical name for that is what I call control to control. So we are coming to also do something about that. Then later on, we look at how disposals are done. So if I already have interest, then I buy another one. What then happens? So we call this one control to control, because I have control and I'm still going into control. So let's look at that scenario, how we deal with it. All right. So this one said it's called what? Control to control. All right. So that is that. So let's say what happens? Increasing shareholders in subsidiaries. And I'm going to change the percentages small. All right. So let's say we have what we have in this particular scenario. So let's say, so example, I have increased my shareholdings. So shareholdings or my equity interest in subsidiary. Now, let's say that I had 80% already. And now I have moved to buy extra 5, meaning I have 85. I already had control. So here, what you would do is that you have to note that point 1, there is no acquisition. All right, that yield control. You already had control. So you won't do acquisition accounting. All right. Whereby you need to calculate a goodwill, do all those things. No, you won't do that. So there's no acquisition accounting, which tells you that you need to not do any goodwill. So no goodwill computation. Because the goodwill was calculated when the 80 was done. Step 2, what do you see? What you see is that the NCI has rather what? The NCI percentage has decreased. So the NCI percentage decreases. What do you see? The NCI used to be what? 20%. Now it is going to be what? 15%. So what we are going to do is to find the difference in the consideration paid for the extra 5 and the decrease that has come inside the NCI. That is the comparison what we are going to do. So you find the difference between consideration paid for the extra 5. All right. For the extra. In this case, in our case, it is 5%. So you are going to do the difference between that and the decrease in NCI. Decrease in NCI. All right. So that is what you are going to do. So how do we do that? So we have the consideration paid. So the cash paid. All right. So let's say you have your cash paid. All right. Then you have your decrease in NCI. Decrease in NCI, which is like this, the difference. So you find what this one will give you a decrease or an increase in what? Now I'm putting the increase here. In what? So this difference, where it will go, we call it other component equity. It will go to your other component equity. You've been seeing that in questions, right? So we call it OCE. Where your share-based payment, IFRS 2, normally goes. All right. So this one, it can be positive, it can be what? Negative. All right. Now, what do you see here? What you see here is that we said this figure is going to, the difference is going to your OCE. Remember, your OCE is a credit balance. It's a capital account. All right. So it's a credit balance. Now, what are you going to do? You paid money, so you are going to credit your cash. All right. That is that. And we know NCI is also part of the equity side of your balance sheet. So decrease in that, you are going to debit. All right. So if this thing results in an increase or a decrease, what is going to happen? These things are going to affect your balances. So once you do these ones, you realize that this difference is going to the other component equity. So if it is like this, then it means that you need to do another debit to your other component equity, then fine. But in the other way around, if it is going to be the credit side too, you will do that. All right. So basically, that is that. That is what you do. All right. But this is not a big problem. The bigger problem is this. The bigger problem that you should have is how to find this OGA here, a decrease in NCI. Because as for the cash, it is the cash. But how do you find the decrease in NCI? The decrease in NCI will represent the proportionate reduction of the carrying amount of the NCI that you had, all right, at the date the additional purchase of shares was done. Because you had an NCA before, and now you have what we call carrying amount of NCI before. Then when the movement also happened, your carrying amount will also change. So that is where you find the decrease. What am I saying? What I'm saying is this. So you have, let me say, this decrease in NCI will represent the proportionate, and that is the word, proportionate reduction. A proportionate reduction in the carrying amount, all right? Carrying amount, CA is carrying amount of NCI at the date of the group's additional purchase of share. So that additional purchase that was done, the group's additional purchase of share, it is the date, all right? Please bear in mind, dates are important, especially in consult, all right? So what are we going to do? How do we find that? Now, this CA that we are talking about here, what you are going to find out is that you are going to find the net asset at acquisition, the step acquisition, that date that happened. So you find this one by doing net asset, all right, at acquisition date of the step acquisition. All right. So that is that, where the step acquisition happened. Okay. Minus the net fair value of net assets. So the day you did the extra, all right, minus the fair value of net assets at acquisition of the time before the step acquisition. You will look at the illustration, so you will see that the step acquisition. So that is that. All right. So that is that. The day you did the step minus what it was before. Now, don't forget, we said it is a proportionate what? Reduction. So how do we do the proportionate reduction? So this is simple. This is what you are going to do. Now, proportionate. So let's say, for example, if the NCI reduces, let's say from 30 to 20, all right? In our case, it is what? 20 to 15, okay? So I will let you do that bit. So let's say, for example, if NCI reduces from, let's say, 30% to a 20%, then what we are going to do, how do we find a proportionate? So what we are going to do is this. If this thing happened, then we know that we need to find carrying amount of the NCI. So we will do carrying amount of the NCI, which I've shown you what to do. So the carrying amount of the NCI would therefore be NCI at acquisition minus the NCI before, all right? So that is that. Okay, so we will come to that, all right? But watch this. The proportionate is done by the difference between this and this. The difference between this and this is what? 10%. Then you will divide it over what? The 30. It is a proportionate change. The proportionate change, you remember, P1 minus PO all over what? PO. So basically that is that. So it changed. So it's kind of a, what do we call it? It changed. The difference on the top is a 10%. Then you divide it by this. So technically you have something like 1/3. All right, at the reporting date. All right, this is the reduction at the reporting date. So that is how what you do. All right. So I just told you that you do the reduction. All right. So when you do the reduction, then you go on to do the carrying amount also. All right. So that is that. Okay. So please take note because we are going to solve examples now. So now don't forget, we need to find this. One of these things is always given to us in the exam. And most of the time, because you are doing the new acquisition, the NCI, the new acquisition will be given to you. But you find the NCI of the old one. How do you do? You know how we do it, all right? So the NCI, the carrying amount of the NCIs, how do you find it? You always know that you do what? NCI, so carrying amount of NCI that you are doing. You always know that you have NCI at acquisition, right? You do that, your NCI at acquisition. Then what do you normally do? Before the step happens, you always do NCI share of post-acquisition, right? Before the step happens. And you do that to add. Okay, so that thing we normally do in our workings for is the same thing here. Nothing has changed, all right? So you add that bit too. And if there is NCI impairment, you would have done that, all right, by now. You would have done that. Okay, so when you do the NCI at acquisition, then you add the NCI share of post-acquisition. That gives you the carrying amount of the NCI before the step is happening. All right, so that is that. All right. But remember, if there was any impairment, like I said, you normally deduct if the thing was done at fair value. Okay, so that is that. But most often, these things, when it is happening, it is normally proportionate. So in those questions are normally proportionate. So what we are going to do is to now pick illustrative examples of what we have done to go through them. All right, so let me bring my corporate reporting book written. There are examples there. Let's look at it. So here we go. This one says that Anita owned 90% of ordinary shares in Frank for many years. Anita also had 10% investment in Benny, which was held in the consolidated statement of financial position as at 2016 at 24,000. So her 10% interest in Benny is 24,000 in accordance with what IFRS 9, because it's less than 20%. Then on June 2017, Anita acquired a further 50. So meaning that he would have how many? 60, right? All right. And this is the cost of the 50. Then we have the draft statement of profit or loss and everything given to us here. Revenue, cost of sales, operating profit and operating cost, everything is given us. Then we are told that the NCI is calculated using the fair value method. All right, good. Then on June 2017, the fair values were as follows. Benny's identifiable net asset, the NCI in Benny, all right, on 30th June, all right. Then the original 10% is now this. So we are supposed to account for this in the Anita group as at 31st December 2017 and calculate the goodwill, all right? So we go back to our question and check dates carefully because as you can see, it is on June 2017, he did the further purchase, all right? So that is what we are told to do. So in this case, always don't forget what we normally do, our group structure, all right? Don't forget your group structure. It's very, very important in all cases. So let's try and deal with this. As simple as you see this question to be, this is what they always expand, all right? It is what they always expand. So in a normal question, they will expand this one small, they'll bring you a balance sheet. It's the same thing, all right? So let's do our group structure, workings one. Group structure as required by IFRS 3. Acquisition accounting. We are only doing this on which date the date control is attained. But as we see before, Anita had a relationship with who? Frank. All right. Frank. All right. And that relationship is a 90% relationship. Okay, so that is that. You take note of that. Then Anita again has a relationship. Immediately control is attained. We are doing acquisition accounting. So Benny, what happens? Benny, here we have 10%, and for how many months? For 6 months, right? Yes, they've had that. So in the current year, as we are doing, the 10% goes for 6 months. Then 60% will also go for 6 months. All right, because when they bought an extra, it became 60, and it was from June 2017. All right. But before, all this were what this and this one were seated in their consolidated financial statement as at 2016. So you see that there is, the step makes it 60 from there onwards. All right. So this is how our group structure becomes. And this group structure is drawn on which date? On the date they think they gain what? Control. And that date was on 30th June. All right. Don't forget that. It's very, very important. These are the principles embodying consolidation. The date control is achieved. That is where you do equity acquisition accounting. All right. So that is that. So you go on to do your workings too normally. All right. So you do the fair value, the fair value of net assets of Benny. All right, at acquisition, which we are giving, is this Benny. All right. So that is that we are giving. Okay. So here our focus is to see how we will do the goodwill. All right. We are preparing statement of consolidated statement of financial profit and loss, and we are also supposed to do the goodwill. All right. So basically that is that. Okay. So we know that from here, we would have done normally our workings too, which is the fair value of net assets. We would have done for this guy and we would have done for this guy, but we don't have those full information. But we know that the fair value of net asset of Benny at acquisition, we know it is what? 200,000. So we know that. But step 3 would have normally been our goodwill, and which the question says we should do. So let's do the goodwill. How do we do that? Fair value of previously held interest. Okay. Fair value of previously held interest. And don't forget, we are doing this thing at the acquisition date. Held interest. Fair value of the previously held interest. They are now telling us that that fair value of the previously held interest, where is the figure? Is the original 10% is now what? 26,000. But we know that previously it was what? 24,000. So that is where you do your immediately, you do the difference between 26,000 and the 24,000. All right, this 24,000, and you get what? 2,000. That thing should go to your what? SPL. So don't forget, when we are doing our SPL, we will have to bring this gain, all right, inside that. All right, don't forget that it will go to our SPL. All right, but as far as our goodwill calculation is supposed to be done, what do we do? This is a fair value gain, right? Yeah. So in the SPL, don't forget that there's a fair value gain. All right. So now what we do is that we have fair value of the previously held interest, then fair value of the additional, fair value of consideration of the additional interest. We are told that the 50 that they bought, they brought it in at a price of how much? 160,000. So we are told that. Okay. So 160,000. All right. Making our total consideration to be how much? That is 186. So that is what we have. So 186. Then what do you do? Fair value of NCI. So NCI at acquisition. How much is that? We are told that the NCI at acquisition here is what? 100,000. Then what do we normally do? After we've done this, we less what? Fair value of net assets of, in this case, Benny, right? At acquisition. So we know that that one is 200,000. So our goodwill, therefore, will be how much? 86, right? So 86,000. So goodwill at acquisition. As simple as that. Very simple. All right. So basically that is that. But we are told to also do the consolidated statement of financial position, right? Normally, there's your workings too, you can do it. All right. You can do it in a proper question that has been given to you, because what you need to do is to find the post-acquisition profit. Okay. Then you share between the NCI and the CI, right? So that is what you normally do. Now, in that case, we will go back and structure our what do we call it? Our P&L. When we structure our P&L, we will come back to share that, okay? Because we have the information here. We have the information here. Yeah. So assuming that we would have done our workings too proper, what we would have done was simple. You remember, and I think you always remember that. Normally, what do? You do fair value of net asset, and you do at acquisition, at reporting, then you have post acquisition, right? We don't have stated capital in this question. We don't have those things, but we do have something for retained earnings, because this is the consolidated financial statement that has been prepared. All right. So technically, so these things are two subsidiaries. So this is subsidiary Frank. All right, and let's say subsidiary Benny, we would have done for the two. So the same thing. All right. What you see in here is that since they came together, we've been given the P&L. So post acquisition for Frank, we have 120. All right, and they've been together since. Then post acquisition for Benny is 16, but you know the 16 we bought, this is the full year 2017, but we had control on June, all right, 2017. That makes it 6 months. So we will do 6 months of this as will be in our post acquisition. I think that one gives us 8. So that is that. This will be the figures. And don't forget, if we are now sharing the P&L profit, this is where we'll be looking up to. So let's go, when we finish, we will come back and do the sharing. So let's do our consolidated P&L, all right? So consolidated P&L, all right? You should write the full thing, okay? So we've been given revenue. We have cost of sales. We have gross profit. Operating expenses or operating costs. Then we have profit from operations. You just repeat them, okay? We also have, what do we call it? Income tax, all right? But don't forget that immediately you get this one. Normally you less finance costs, you add investment income. There is an investment income. And that was the 2,000 we did, all right? Don't forget that. Investment income, change in fair value. All right, so then we have profit before tax. Then we will have tax. All right, so that is that. How do we do this part of? So we have Anita's own to be 500 plus 300 plus 6 months of Benny. That is that. If there were any intra-group, you know what to do, all right? So that is that. Cost of sales, we have 300 plus 70 plus 6 months of this. So that is that. Okay. Now we get our gross profit. Okay. Operating cost, that is 60 plus 80 plus 6/12 of the 60. All right. So that is what we have. Then we get our operating profit. Then the investment income. Don't forget, let me put the 3 zeros in here. The investment income was from our workings 3, right? When we were doing the goodwill. Okay. Or you can do it as part of your workings 2. It is best you do it as part of your work. Immediately you do the fair value of those things, just do it under it and do that one. Or you can also say that as part of the group structure, immediately I do the group structure, I will do it as part of my workings 1. Then you also put the workings 1. Wherever you put it, please do that. All right. So that is that. So, and we have profit before tax. As for this one, I know it's 2,000. So since we put 3 zeros there, let me write 2. All right. So that is that. And tax is how much? Tax is 28 plus 30 plus 6/12 of 4. All right. So that is that. So let's close them and put in the figures. All right. So as far as sales is concerned, this one gives me 900. All right. Then cost of sales, 430. So my gross profit therefore becomes 470. Then operating cost also gives me 170. So therefore this side is what? 300. All right. Then I bring in the 2, that makes it 302. Then the tax 2 is 60. You do half of this and you add that one too is 60. So what that gives me therefore is 2 forward 2. You know, we share this. All right. And sharing this, you do your attribution. Okay. So let's do the attribution. So profit attributable. So let's do the attribution. Attribution, therefore, we have those to the parent of the equity holders of the parent. That one is always the balance, all right, of parent. Is the balancing. But how do we do the NCI? The NCI, go and visit your workings 2. All right. If you go and visit your workings 2, you realize that you have an NCI, which we did. All right. So in these 2 cases, what we have is that since we have consolidated 2 accounts, the first one, we had 120. That is normally your working. So the one that you do, the one you total, the post acquisition, the side that you total, you are going to do the NCI portion of that. For this one, the NCI portion is 10. So you do 10 of 120 and that gives you 12, right? All right. Now, if you do this, if you have had an NCI share, because the NCI, you are going to do 2. All right, just as you did goodwill 2. If you had this figure would have been seated there. Fair value NCI share of post acquisition, it will be seated there. And if you have any impairment that was also seated in your NCI workings, you deduct that particular impairment. This one, there is no impairment. So the same way, this one too, how much the NCI percentage for this one was what? 40 as at the time. So that one will be 40/8. And 40/8, all right, will give me like 3.2. So total, my NCI sharing is what? 15.2 for the 2 companies. So that is what you do. So be careful when they mix this thing up with the complex group. You know what to do. It can be mixed up, all right. So that one will change this percentage. All right, so we know that the NCI is taking what? 15.2. And if it takes 15.2, the remaining balance, all right, will go to the parent, and the remaining balance will now be 226.48. So this is how we do it. All right. Most importantly, is something new you have learned in doing your goodwill. All right. So if you are doing balance sheet, this is our goodwill. So that is how it works. All right. So this one is a step acquisition. They had 10, they bought 50. All right. So that is that. So thank you. And let's pick another example. All right. So let's take this trial question. It says that the financial statement of two entities, major and minor, as at 2016 as well, you see. So you have the investments, we have sundry assets, then we have equity shares, retained earnings and liability. All that an examiner needs to do is to just open it up and add some other things. All right. So this thing we are doing is just a set of how your exams always look like. So now, what are we going to do? What we are going to do is to take the reading of the other information. So the additional information as we have here, what do we have? We have, as you can see, we have major acquired 40% of minor in 2011 for 90,000. Then at this time, the retained earnings was what? 76. A further 20%, all right, in minor was acquired. So you realize that once they acquire this, they have control because it will go to 60%. And it was acquired 3 years later. Okay, so our date is 3 years later. And on this day, the fair value of the existing holding in minor was 105. All right. Then the minor retained earnings on the second acquisition date is 100,000. The NCI is via the proportionate method. Most of the time, these questions, that is what you have. You are asked to prepare a balance sheet. So how do we go about this? Just as you know, you have to do your workings one. Your workings one, which is your group structure. All right. And these things we do is coming from IFRS 3. Don't forget that. All right. So let me make sure my screen is shared. All right. So what do? We have major and we have who? Minor. So that is what we have. Okay. Be careful about the date. When are we doing this? We are doing this when control is achieved. And when was control achieved? 3 years later. That is what the question said. So please take note of that. 3 years later. Okay, and it is done on December. So it means this thing we are doing is a full year, because a 3 year later also gives you like December 31st or January 1st of whatever year. You know, in accounting, 31st December and 1st January the following year is the same. All right. So right here, as we are doing this, the percentage is 60%, not 20, not 40, not 20. We are doing this at a time control was achieved. And this one is 3 years later. You can show 40% and say that one was at 31st December 2011. But our focus here is 3 years later. And 3 years later will be what? Something like 31st December 2011, so it will be 2012, 2013, and 2014. So that is something like this. All right, that is what you have. Okay, so that is it. Now we are supposed to prepare this financial statement when? 2016. So if you check the 3 years later and the 2016, it means our period to reporting date is what? That's like 2 years. All right, so you put your 2 years there. You've done with your group structure. So let's come to workings 2. Fair value of net assets of SAP. In this case, our SAP is minor. All right, so we will do at acquisition, at reporting, post-acquisition. All right. For those of you who don't know, I am somebody who didn't really attend classes of this sort when I was writing my CA in Ghana. So I was taught consolidation by a popular lecturer in UK called Francis Braganza. All right. And he did a very good job teaching me the basis of consolidation. All right. So he's the one that actually taught. So what I do here is may sound unpopular in the Ghanaian context, but it is the way to go. It is the best way to go. And that is how it is done in ACCA. So it's the best way to go. All right. So keep with this. All the lectures that I give is from the background of what ACCA, and it is the best you can have. I break it down to the barest minimum. All right. So here we have our stated capital, all right, which is the share capital of minor, which is what 100,000, and this is it. Then we have what retained earnings. So straight, which one do you write first? Don't forget reporting. So reporting is what 122. What is the fair value of net asset at acquisition? We are told that, look at this. Look at this. We are giving the stories here. Now, the stories here told us that 40% was acquired. At the time, the retained earnings was 76. That is way, way back. Now, a further 20 has been acquired 3 years later for this. On this day, the fair value of the existing holding in minor is this. The retained earnings were 100. So have you seen 100? So retained earnings as at this time is 100. So that gives us a 22 here. If there were PAPs and all those things, we will work fair value adjustment on all those things, we will work. But as it stands now, this is the only information we have. So we have 200. We have 222. I am not interested always in the middle one because it adds nothing. So that is that. And don't forget, I told you that immediately you do this thing, you should find the gain or loss on investment, because what you have is that previously the guy's investment, previously he had a 40% and it is what 90,000 previously held interest. Now, as they are buying on this date, the fair value of the existing holdings, that 90 is what 105. So currently its fair value is what 105. So what is the difference? That is like 15,000, right? So this one is a gain. Where do we put it? In the P&L. Now, since we are not doing a P&L, where should that thing be? Group retained earnings. Because the group retained earnings is always a representation of what? Your P&L. All right. So that is that. So we've done our workings 1 and 2. Let's go and do workings 3. Goodwill. We have only one subsidiary, so we need to, and don't forget, everything we are doing is in zero. So this 15 that we have, we will record 15. All right. So that is that. So let's do the purchase consideration. How do we do that? The fair value of previously held interest. Now that interest is what? It says that interest is 105. All right. The fair value of the previously held interest, now it is 105,000. That is what we have. Then what else? The additional. Don't forget, this one was a 40%. Then the additional 20 that they bought, how much did they pay? They bought it for 70,000, right? All right, so 70,000. That makes our purchase consideration 175,000. What do we do? NCI. Now, this NCI wasn't a fair value, so we will do proportionate, which is what? 40%, because now together it makes 60%. So NCI will be 40% of the 200,000. So what is 40% of 200,000? 0.4 by 200. That is 80,000. All right. So that is that. Then we less what? Fair value of net assets of minor at acquisition, which is the entire 200,000. So we do this. How much do we have? So we have 175 plus 80 minus. All right. This one, we didn't do it in 00s. You see that we wrote everything. So minus 200. I am punching it in 00s. My goodwill, therefore, is 55,000. So that is that. So that is goodwill. That is goodwill. What do we do normally? We do workings for, right? But I can always tell you, immediately you find your goodwill, just go and do your balance sheet. All right. So you start your balance sheet with goodwill. And as we have found from workings 3, that is 55,000. Then we come with the other things, all right, the investments and all those things. Okay, so that is that. So bring in your investments, bring in your sundry assets, all right, come to your equity. You see, I've left some space there because anything can happen. You should do same, right? Stated capital. Stated capital is for who only? Parent only. All right. And if I'm writing everything in full, this one will be 200,000. All right. Then I have my retained earnings, which will come via group retained earnings, and that will be my workings 5. And I'll total those equity side. Then we will come and also add workings for NCI, which we are about to do. Then we have liabilities. Okay. So let's go and continue what we are doing. So now let's do our workings for. Workings for, what do we have? So in our workings for, we'll bring the NCI. So what is our NCI at acquisition? So NCI at acquisition, what do we have? We had it in our workings 3 and it was 80,000. Then NCI share of post-acquisition profit. So that one, our NCI is 40%. What was our post-acquisition profit? I think it was 22, right? 22,000. Okay, so let's do that. 22,000. And that is 8,800. All right. So basically that is that, because if you do 40 by 22, it's 8.8. All right. There are figures that should be popular with you. There is no impairment, so we can close that one down. So that is 88,800. So we have our NCI. Don't waste time. Go and slot it inside here as 88,800. All right, so that is that. Let's do our workings 5 and bring. All right, I think this one, we don't have any PPE adjustments inside. The investment is 160 minus all the purchase consideration that has happened. They had 90 before and they bought another 70. That makes it 0. All right, so that's why some people usually don't present that. The asset, what do we have for the asset? There's nothing concerning a PPE adjustment or anything. So we have 350 plus 250. So 35 plus 25. That is 600,000. All right. Okay. So that is that. Don't forget to be adding the 00s, all right, when you are doing it. So it means that our total asset is 655,000. All right, let's see if we can help with the balancing. The liabilities too, we weren't told anything about the liabilities. So the liabilities too, we have 60K plus 28. So that is 88,000, right? So 88,000. So that is that. Okay. So as you can see, we need a 200 to offset, and that should probably appear in our group retained earnings. So let's do our group retained earnings. See how best we can balance this. So group RE, we start with the parent own. How much is the parent retained earnings? We have 250, right? So that is that 250,000. So let's write 250,000. Then what do you have? CI share of post acquisition. So that is the 60% of the 22. I'm sure that is where the 200 is hiding from. Yeah, I have 13,200. All right. What else have been to be brought? Is there PAP? Is this thing is supposed to be 200? Is there PAPs and all those things? There is one thing you remember, the revaluation of the previously held interest. So revaluation of fair value of the previously held interest. It used to be 90, but it came to 105. 105. So minus 90 gave us what? 15,000. All right. It should be in our P&L, and this is a representation of our P&L. If there is any other thing that we should do, then we do normally in terms of PAP and all those things. You know those ones already. So this one is 13,200 plus 15,000 plus 250,000. So what do? We have 278,200. So let's go and slot it inside our balance sheet. 278,200. So if I add my equity side, this one should be 478,200. All right, so that is that. Now, if I now add the 88,800, so 88,800, that gives me here 567,000. Sorry, 567,000. Then I add my 88, and it gives me 655. So that is how you learn your way through these ones. Okay, so this is a step acquisition. All right, so that is that. Now we will be taking examples, and especially we've done a step acquisition. All right, and so we should try and do the control to control. We will look at those ones too. So the last thing we probably need to look at is the control to control scenario. All right, then we will end this part of the video. We come up with chapter 3 where we discuss the disposals. All right. Okay, so let's do an example of control to control. So we have this example here. All right, so as we understood it, this one had Amanda owns 80% of Mandy for many years. Amanda is considering acquiring more shares in Mandy. The NCI of Mandy, as we see here, currently has a carrying amount of 20. So the NCI currently has a carrying amount, with the net asset and goodwill having a carrying amount of also these ones respectively. Then Amanda is considering two scenarios. Amanda could buy 20% of Mandy, leaving no NCI. All right, so that is that full one. Then Amanda could only buy 5%. All right, so what do we do with these scenarios? Okay, so let's work them. So in these scenarios, we have two scenarios. So let's see what we do. We have scenario 1, where Amanda is purchasing 20. Since the board is slowing, let me just change the board. So what we have in this scenario is that Amanda, scenario 1, Amanda is purchasing. So we do purchase of the 20% in Mandy. Now, what is going to happen is that what we are going to do, we said that there's no goodwill to be done, nothing what we do is that this one is a transaction between equity holders. So what we do is do the cash paid. You remember? We find the cash paid. How much are they paying for the 20? Is what? 25,000. So that is what we have. Then what is the decrease in NCI? Because the decrease is that this thing is decreasing. So decrease in NCI is coming from, the NCI is moving from 20 to 0. You remember the proportionate thing we did. So 20 minus 0 will be 20. So it will be 20 over what? 20. All right. So that is what you do. Multiply by what? Multiply by the carrying amount as at then. So how do we find the carrying amount as at then? Good news for us. It says that the NCI of Monday has a carrying amount of 20,000. So here we've been given the carrying amount of 20,000. All right. So that is that. And these are the net assets things too that we have. All right. So the carrying amount is what? 20,000. So that tells you that the decrease is also what? 20,000. Don't forget, what do we do to this? We credit cash. What do you do to this one? We debit our NCI. And therefore, what do we have here? What we have here is like a 5,000. Okay, so we have 5,000. The difference is a 5,000. All right, and this 5,000 should be a debit against this so that we can have 2020. All right, so or you add the debit to this, okay, so that you can have. So if you debit this one particularly, you see it balances to what? I mean, 20,000. So or you can do the debit inside there so that your final answer will be 2,000. I prefer it this way. All right, so this is what will happen. All right, so that is that. And this is a decrease in what? This one is a decrease in OCE. All right, it's a decrease in OCE. All right, so that is that. Take note of that. All right. Now, what is the second situation? In the second situation, we have Amanda doing just 5%. So the same thing, the cash paid. So here she's doing only 5%. Cash paid is how much? Cash paid for the 5%, and he's leaving 15% NCI, and the cash paid is paying 4,000. So we will debit our cash. Oh, sorry, credit our cash. Then what is happening? The decrease in NCI is going to be what? The decrease in NCI was 20 to 15. So proportionate wise, what will we do? It will be 5 over what? 20 multiplied by what? The 20,000. It's just that sometimes you need to find this yourself. The CA of the NCI. And I've told you, what do you do? NCI at acquisition. All right. Then you add your NCI share. All right. Those things. Okay. So this one will give us, like that is 5,000, right? Yeah. So 1/4 of this 5,000. The 1/5, right? 5,000. So this here goes here 1. This here goes here 4. So 1/4. All right. So divide it is 5,000. And this is a debit. All right. So that is that. So you see here, we need to continue to credit what? OCE. All right. So basically that is that. So we have a negative. The negative is a credit to OCE. A credit to OCE is an increase. All right. Because OCE is a credit to transaction. So this is what we do. So when you are doing your balance sheet, remember these things. All right. Particularly this one. All right. So that is that. So this is how we do control to control. All right. So in the next video, we will do disposal. All right. So disposal, we have disposing 100%, everything you had, or you are disposing some to leave an interest. That interest can be an associate interest or investment interest. If you leave a subsidiary interest, it is called disposal not to lose control. All right, so it still fall under control to control. We will look at that. All right, then there is the IFRS 5 aspects. All right, NCI or subsidiary bought for the sole purpose of resale. All right, so we will do that. Thank you very much for your time. You will see ourselves in the part 3 of changes in group structure. My name is Thomas, and you should, you actually should subscribe and like our channel. All right. So thank you very much and see you next time. Bye-bye.